All right, since we're kind of running out of time, so let's move on to the next paper. The next speaker will be Tianyue Ruan from National University of Singapore. So Tianyue, the floor is yours.
Okay, thank you very much. I hope that everyone here can hear my voice and see my slide. I want to thank the organizers for including this paper in the program. I'm very excited to present this paper, joined with Ben Charoenwong and Meng Miao. So this paper is concerned with the management of non-performing loans, NPLs, or troubled banking assets more generally. So one widely used approach to clean up troubled banks is to set up asset management companies, or AMCs, that are designated entities to take over the NPLs from banks and resolve them outside of the banking sector. These type of designated institutions were first used in the late 80s and early 90s in the US and Sweden. And since then, it has been used widely in developed and developing economies alike to clean up troubled banks after the financial crisis. Most recently, given the expected rise of distressed debt due to COVID pandemic, the European Commission and the Indian government are the latest government authorities to lean into this idea of setting up AMCs. But even though we have a lot of endorsement from various governments and policymakers, we actually know very little about how AMCs work. Do they live up to their intention? In this paper, we want to open up this black box by using China as the empirical setting. So as some of you know, the use of AMCs to clean up bad debt or non-performing loans have at least been around for more than 2 decades. At the beginning, there were 4 national AMCs set up by the central government after the Asian financial crisis. More recently, since 2012, another type of AMCs known as local AMCs could be established to take over NPLs from banks. The new regime after 2012 is very flexible and poses very few restrictions on banks offloading NPLs through AMCs. So this practice is very widespread. So compared to other countries, which had a more targeted and short-term uses of AMCs, this setting in China permits us to conduct both time series and cross-section analysis of the AMC model. So our research questions are twofold. First, we want to evaluate the performance of the AMC model. We want to see, do the NPL transactions conducted by the AMCs reflect orderly resolution of troubled assets, and what are the implications for financial stability? So we find that to the large part, these NPL transactions appear to be concealment from financial regulation rather than orderly resolution. Important implication of this finding is that banks are still exposed to the NPLs, even though these NPLs are already removed from their books. This is what we refer to as hidden NPLs. Recognizing these hidden NPLs implies that the true NPLs in the China's financial system are at least 2 to 4 times the reported amount. So we speak to several strands of literature. First, on the measurement and resolution of problem loans, we document that the hidden NPLs are very prevalent and should be recognized. Second, setting up designated entities such as AMCs to clean up NPLs has generally been viewed positively by policymakers and academics. We point out that contrary to the policy objectives, these entities, they can actually cooperate with banks and enable banks to conceal NPLs. And thirdly, this is a paper also related to the effectiveness of financial regulation. We document a novel mechanism of regulatory arbitrage, which is the concealment of NPLs in China. So before I move on, I want to briefly talk about the institutional setting. So banks in China, they are required to adopt these 5 categories of loan quality. The bottom 3 categories, substandard, doubtful, and loss, as marked by red here, are collectively considered non-performing loans. So I want to point out that there is no direct mapping between how long a loan has been delinquent and the 5-category classification. Banks are allowed to use their internal risk models to do this classification. So in 2012, the Ministry of Finance and the China Banking Regulatory Commission launched a new initiative that allow a new type of AMCs to be established to take over NPLs from banks and resolve them. So these new type of AMCs are known as local AMCs. They are different from their predecessors, the national AMCs, in a few different regards. First, they are not set up by the central government, and they are not directly regulated by the China Banking Regulatory Commission. So, but despite the name suggests local, their presence can expand beyond their provincial boundaries because they do not face restrictions for the most part on cross-province operations. So how this works is that banks package non-performing loans and sell to the local AMCs. So these sold loans are removed from the bank's balance sheets. By the end of 2019, there are 59 local AMCs being set up. So our data comes from a leading local AMC. We have information on all the NPL transactions this AMC has conducted since the establishment in 2014 till 2019. So altogether, we observed 257 transactions. Each of these transactions is a package of many loans. The mean transaction size is 642 million Chinese yuan. We observe a wide range of banks who does business with this AMC, ranging from the big four banks to the smaller regional banks. In terms of their geographic location, we also see banks that are located or headquartered in developed tier 1 cities to smaller cities or rural areas. So we first document an empirical association between regulation and NPL transactions. So banks, they are faced with loan quality regulatory minimums. Specifically, a key ratio is this ratio known as allowance to NPLs ratio, defined as the allowance for loan losses relative to the balance of non-performing loans. Banks need to maintain this ratio to be above 150%. So if a bank has more non-performing loans, it needs to set aside higher allowance for loan losses, which would reduce their profit. So in the data, this ratio is binding, at least for some banks. We find that if a bank is violating this ratio, it's more likely to transact NPLs to the AMC. And the NPL transactions also lead to or followed by more lending and less regulatory violation in the future. So this is the empirical association. In the interest of time, I'm going to skip the tables for this part. I want to point out that this empirical relation is consistent with two very different scenarios. First, because there's this regulation that is binding, the pressure to comply with this regulation may incentivize banks to behave as the regulator wants and do more orderly resolution of troubled assets by moving their NPLs to the AMCs. So, but on the other hand, the same pressure may incentivize banks to conceal the NPLs from financial regulators without actually resolving these NPLs. The distinction is important for financial stability, and the bulk of our paper is our attempt or our analysis that trying to make the distinction. So we consider three different plausible scenarios. The first one is an orderly market-based resolution, where AMCs, they acquire NPLs from banks at fair prices, risk-adjusted, and work to resolve these NPLs. So this taps in the market mechanism for price discovery, and according to what the 2012 deregulation wants, this is also the intended objectives. So this scenario represents risk transfer of banks to the AMCs and potentially to other market participants if we follow through these NPLs. The second scenario is what we call a government-backed resolution, where AMCs act as agents of the government to bail out the troubled banks. So in this form of government bailout, we observe that the risks associated with the NPLs are transferred from banks to the AMCs, potentially to other government entities. Lastly, there's a concealment scenario where banks devise strategies to conceal their NPLs without proper resolution. Importantly, the risks of NPLs do not get resolved in this scenario. It just gets buried outside of regulators' scope. So in this form of regulatory arbitrage, banks may still retain risk exposures to the NPLs. So with these plausible scenarios in mind, we go ahead to look at NPL transaction characteristics and outcomes. First, I want to show you the summary statistics here. As I mentioned before, each of these packages is a package of many NPLs. So on average, there are 115 loans from about 87 borrowers. So the average delinquency of these loans is over 4 years. So given that this delinquency is so high, the NPL transaction price seems rather high. So we calculate a haircut, which is the transaction price relative, the haircut of transaction price relative to the face value. This one haircut has a mean of 5.1% and a median of 0%. We also want to point out that this AMC reports that for every single transactions they have ever done in this few years period, they receive funding from the bank that's selling the NPLs 100% of the time. And you also, in 100% of the time, the collection obligation is redelegated back to the bank. So we believe that these two observations are very at odds with the resolution. So this is empirical CDF of the haircut of transaction price relative to face value. We find that the majority of the transactions had zero haircut. Only less than 3% of the transactions have a large haircut greater than 30%, and 8% of the transactions actually had a premium. When we look at what might correlate with the haircut, we find something very difficult to square with risk adjustment, which is that the longer the loans have been delinquent, the lower the haircut. So we believe that this is strong evidence of prices not reflecting credit risk. Next, we want to look at what happened to these loans after the AMC has purchased them from the banks. On average, a package stays with the AMC for a little bit less than 2 years. After that, the majority of these packages are resold by the AMC. 74% of them go to a third party without further syndication or rebundling. And I want to point out that the resale premium, which is the difference between the resale price and initial sale price, is always positive with a minimum of 15% and a maximum 3%. So these third parties, you may wonder who they are. So for 100% of the observations, we do observe that these third parties are in the same city as the banks that are selling the NPLs in the first place. And for the most part, these third parties are existing borrowers or other clients of the banks. So we believe that these are bank affiliates. So when we look,
you have 2 minutes.
Okay, when we look at the resale premium, so we find that the only thing that seems to matter is the holding period of the holding period of the NPLs at the AMC. Nothing else matters. So this regression result is actually even more obvious when we just look at the unconditional pattern, where I plot the holding period in the horizontal axis and the resale premium in the vertical axis. We first see that the holding period clusters in a multiple of 6, as the line up blue dots can show, and also it is increasing the resale premium is increasing with the holding period. So this suggests that, first of all, the holding period is difficult to square with natural occurrence of offloading transactions. And second, these likely reflect a commission schedule that AMC charges. So lastly, the market do not react to the NPL transactions. So I think given in the interest of time, let me wrap up and then open the floor for discussions. So we entertain 3 different predictions. We believe that our empirical results are more consistent with the third prediction, which is concealment. First, most transactions have 0 haircut, some even at a premium. The haircut decreases with delinquency and increases with bank health, both of which are inconsistent with risk-based adjustment. Second, we see that banks provide financing to the AMC to purchase these NPL packages, and banks return the obligation to service these NPLs even after they remove the NPLs from the books. Lastly, I want to point out that resales are very prevalent, and all the resales take place at a positive premium, and to third parties that are likely to be borrowers or clients of the banks. So taken together, our results, different pieces of them, point to this movement of NPLs in the financial system. Banks want to evade regulatory pressure by moving NPLs out of the book to the AMCs while providing financing for the purchase and returning obligation to collect. The AMCs act as pass-through entities and profit through the resale premium. The third-party bank affiliates are the ultimate holders of the NPLs. So I think in the interest of time, I may not have time to go through the last part. Let me stop now and let's move on to the discussion. If there's interest, interest in the Q&A, I can talk more on these aggregate implications.
All right. Now let's move on to the discussion. So let's welcome Professor Takeo Hoshi from University of Tokyo to discuss the paper.
Okay, thank you. Then let me share my slide here. Okay. Since I'm the last formal speaker in the last session of today, let me start by thanking the organizers, Ippei and Helen, for getting together, putting together a great program. Thank you very much. Now, on this paper by Tianyue and her co-authors, I like this paper a lot. The paper is very critical on AMCs in China and has very important message. The issue of NPL, the non-performing loan, is something we discussed a lot about Japan 20-some years ago. So reading this paper reminded me of many seminars and conferences that I attended with some people in this room, or virtually back then when the issue of NPL came up for Japan. So I want to start my discussion by talking about one of those sessions that I remember. I think it was back in 1995. I gave a talk at the Bank of Japan as a part of a seminar for central bankers in the Asian countries transitioning from the planned economy to the market economy. That was another topical thing in early 1990s. And I talked about the resolution of systemic insolvency in Japanese banking immediately after the World War II in the late 1940s, which were relevant to many transition economies back then. And I don't remember if we had participants from China, but Ippei was there as a junior official at the BOJ. And actually, that was the first time I met him. So in that session, I started the talk by saying the topic of the systemic resolution is relevant not only for the transition economies, but also for Japan back then in mid-1990s, which may be experiencing a banking crisis again soon. Back then, the official number for non-performing loans in Japan was just started to be disclosed. But although that was only for major banks and for the loans past due more than 6 months rather than 3 months and so on. The official number was something like 15 trillion yen, small number if we look back from now. But I said the true amount may easily be double that or more, 30 to 50 trillion yen. So my message was very much similar to this paper's message today. And then Ippei's boss interrupted me and told me that I shouldn't speculate. The official number is 15 trillion yen, and let's start there. So I said, okay, and I moved on talking about the banking sector resolution in the 1940s instead of 1990s. I don't know if Tianyue or her co-authors have talked about this paper with Chinese regulators, but I wish you good luck. It's an important paper, and they should know. So now let me start discussing this paper. First, here is what I took away from the paper. So the main question is that does the AMCs in China resolve non-performing loans or just hide them? Okay, they distinguish between market-based resolution and government-based resolution. I don't think that distinction is a very important one. If there was a market for well-organized market for NPLs, I don't think the government would be using AMCs to solve the problem. So the existence of AMCs suggests this is, in some sense, government-led. And their answer is that banks use AMCs to hide NPLs. This has nothing to do with resolution of NPLs, but everything to do with the concealment of NPLs. And they find supporting evidences. I don't go through those because Tianyue went through most of those, but they find the supporting evidence. And at the end, this is something Tianyue didn't have time to talk about today. They calculate the amount of hidden NPLs in China, and they conclude this is as much as 2 trillion renminbi, or 9.25% of the aggregate banking capital. And this is a number assuming 80% loss given default and 50% pass-through from ultimate owner of these loans to the banks. So comments, again, it's a very good paper. I totally believe the result. AMC were used to hide NPLs from the public. And it sounds very familiar to those who studied the NPL problem in Japan in the 1990s, because Japan, one of the things the Japanese government did was to use AMC. Okay, I didn't see Japan in your list of the countries which used AMCs, but you can add that later. So my comments have, there are two types of my comments. One is, I think, more explicit comparison to Japan's AMCs, looking into more experience of Japan's AMCs will be useful. So that's one line of my comments. And the second line of my comments is, I'd like to know more details on several aspects of China's AMCs, because there are some things that puzzle me. Okay, so starting with Japanese AMCs, this is a biased list of the papers which look at the Japanese AMCs. And I have a paper with Neil Kashyap. And probably the person who knows best about Japan's first AMC, called CCPC, has nothing to do with the Chinese Communist Party, is Frank Packer. It's too bad Frank is not in the session, but if you haven't done so, you should send your paper to Frank and solicit his comments, because he studied Japanese AMC in very detail. And this is a table from my paper with Anil on asset management companies in Japan. And the CCPC, the Cooperative Credit Purchasing Company, it was the first one created in Japan, the first AMC created in Japan, and they bought non-performing loans from the banks. And in these setup, these are the bank finance those purchase of bad loans at CCPC. And so this is similar to what you find for Chinese AMCs. And we assess the Japanese experience, and we conclude basically the Japanese AMC experience was a failure. They didn't deal with resolution, the bank resolution, the resolution of the non-performing loans. They didn't contribute to that very much. And here are the several reasons why the Japanese AMCs didn't work. They are limited to specific financial institutions and the insufficient scale of operation and so on. China seems to have avoided at least the first two. These AMCs, at least taken together, are big and covered many financial institutions. And ultimately, the asset purchases did not remedy the capital shortage, which was the biggest problem for Japan. I'm not sure how important this is for China, which I'd like to come back in the end of this comment. So the Chinese AMCs versus the Japanese AMCs, I'd like to see more comparison because I think we can learn a lot. This paper finds that AMC used funds borrowed from the banks to buy the NPLs, but this was a feature in CCPC. And nonetheless, even if the banks lend money to AMCs to buy NPLs, as long as the AMC buys those NPLs and get rid of those in the market, that would contribute to the resolution. Okay, and so the problem of CCPC is they did not get rid of the loans quickly. But in Chinese AMCs, they seem to be getting rid of loans reasonably quickly. So that may not be a problem. One thing I didn't see in this paper is, and it is critical for it to judge if those are non-performing loans were really removed from the bank's balance sheet, is what happens when the AMC sells NPL with losses. Okay, can AMC ask the bank to compensate for loss, which was the case for Japanese CCPC? And in that sense, Japan CCPC did not remove those loans fully from the bank. But if not, then selling to AMC, if the AMC doesn't have recourse to the banks, then the selling to AMC removes NPL from the bank's balance sheet. So that seems to be okay. So I would like to know more about that. This is one of the results this paper gets. Higher NPL haircut for banks with higher capital ratio. And I think there is a way to explain this, but I want to point out something different here. That is, can we trust the capital ratio of these banks anyway? You know, the capital ratio is something the banks can calculate and announce. And back in late 1990s, we couldn't trust the capital ratio for Japan. So I'm not sure what's the situation for China. Here is a list of the Japanese banks, major Japanese banks in March of 1998. And I lined those up with capital ratio from highest to the lowest. And S&P rating back then is listed on the last column. And as some of you note, the first two banks failed within 1998. They had the highest capital ratio. The most healthiest banks tend to have a low capital ratio back then. So I'm not sure how much we should trust capital ratio, especially when the banks are having lots of NPLs and they are trying hard to hide them. Now, I'd like to know more about Chinese NPLs, and there are some naive questions. This paper describes very elaborate mechanisms to hide these NPLs, but my question is why they have to do this? they use an internal model to classify non-performing loans and the performing loans. Can't they just classify non-performing loans to performing so that to hide those loans without going through AMCs and so on? And another thing I didn't quite get it is there are lots of things AMCs can adjust to basically getting reward from the banks, to hide these NPLs, right? They can buy those NPLs cheaper, which they don't seem to do. They can add resale premium, which they do. There's something called annual commission fee, which I didn't quite understand. If they are getting paid by holding on to NPLs, which doesn't make sense, but if they may get money, they can adjust the loan term from the banks, and there may be some other side payments. There may be some side payment arrangement between ultimate buyer and the banks. So I would like to know more about the Chinese NPLs, especially why they have to go establish this elaborate system in order to hide NPL. Okay. Let me skip these and let me just spend 1 minute talking about the NPL calculation, the aggregate hidden NPL calculation. This strikes me as, if my calculation is right, this strikes me as a not so big number you're getting at. So assuming loss given default of 80% and 50% pass-through, hidden NPLs is just the 9.25% of the aggregate bank capital. Okay, and the Tier 1 capital ratio as of March of 2021, according to CBIRC, is about 12%. So losing 9.25% just to bring this down to 10.8%. This is still, I would say, well capitalized, and I would conclude that the banking sector, at least in aggregate, can withstand the stress. Now, although the aggregate numbers may hide some serious heterogeneity, so some banks were in seriously bad shape, but still the 2 trillion renminbi of a hidden NPL doesn't seem to be that large number. Okay, let me stop here.
All right, we have 5 minutes left. So, Tianyue, do you mind take a minute or two to respond to the comments and the suggestions?
Yeah,
and then we might just take one question, I guess.
Sure. Yeah, I think I may not have time to respond to every point of Takeo's comments. They are all very insightful. Maybe in the interest of time, let me just share more details on why, some institutional details. So for instance, you asked about one of the things is that this commission. So basically commission, so we have reviewed contracts, which the details we are not allowed to share, unfortunately. So in the contract, sometimes there is a commission, but the commission is paid out to the AMC through the form of the resale premium. So the commission number written on the contract is almost equal, or like it's very similar if we just multiply by the annual commission. If we just multiply that number to the length of holding period, which we believe is agreed upon ex ante, so then we get something very similar to the resale premium. So we believe that the resale premium, which goes to the AMC, the revenue, is the format that AMC receive commissions from the trade. So I think this is just one of the very one of the institutional detail that I didn't have time to talk about in the presentation. Yeah, I think if there are questions on the floor, I can take them.
Okay, let's take a look at it. It seems there's no question yet. So if you want to elaborate, still you have time.
Sure. Yeah, I mean, then I can elaborate. And I am very grateful for the references to the AMCs in Japan. So I mean, I must admit that because I don't know Japanese, I don't think I know enough, and a lot of the English literature, the papers written on English, I mean, we didn't find enough information by ourselves for these Japanese cases. We are definitely going to take a very closer look at the Japanese experience and draw a more detailed comparison, which I think is definitely we definitely should put this into our paper. And the second thing about let me just share a little bit about my take on why the banks need to do this to hide the NPLs. Why can't they just use the internal risk model? So first of all, China is under pressure from IMF and other international agencies to eventually get rid of this internal risk model allowed to the banks. So IMF have been pressing China for years to just declare that just link delinquency to the loan quality measures. So China has not done that. But in recent years, in our sample period, China has been working towards the eventual link of delinquent status and loan quality. So for instance, because the delinquency status is also published in the financial report, so the regulator can look at that. If you behave well as a bank in terms of you classify these highly delinquent loans as NPLs, you will get other relaxations in other regulatory measures. So in our sample period, this internal risk model is allowed, it's not outright forbidden, but there are other pressures that make just outright manipulating these numbers be more obvious to the regulators. So given that banks face very few restrictions on offloading these NPLs to the AMCs that we talk about, in equilibrium, banks appear to think that the shadow cost of doing this offloading is lower than manipulating their internal risk models and subject to risk to be caught by the regulator. So this is something that not just the bank to basically go through this more elaborate route of hiding NPLs. So yeah, I guess this is something I just want to share. Okay.
Okay. Any other questions?
Sure.
If not, let's call an end to today's session. Thank you all for participating in this session, and it's a great session on Chinese economy. All right.
Thank you very much.
Thank you.